What's going on? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Carvana stock because last night after hours, the stock was down about 6.5%. Today, it's recovering a little bit, and now we're only down 4%. But if you look at the last couple of years for the stock, it's been all over the place. 4 years ago, it was up to 360 a share. Then about a year ago, or 2 years ago now, it was down to $7 a share, and it's come all the way back up to 191 now. So the news today is that Hindenburg Research is shorting Carvana and accusing them of accounting manipulation, which definitely does not look good for the stock. But then you have, companies like JP Morgan coming out and saying buy their shares. And I mean, most of the time, Hindenburg is pretty good with their research. But at the same time, sometimes, like I just bought a stock recently, SMCI, that was accused of the same thing. And then when they had other companies look further into it, they actually had no problem there and the stock recovered. So there's always, different scenarios that can play out. But the one thing I want to point out with this company is they have market share of 6.7%, which is not a ton, it's not a lot, but it's still pretty good for the size of the market they're in. And if we take a look at their financials here, what we're going to see is that revenue peaked in 2021, 2020, let's say 2022. And again, that's like around the time the stock price was super high. Then it dipped down to $10 billion dollars about a year ago. And then since then, the last 4 quarters, it's been recovering. So the trend is definitely in the right direction here. Net income, pretty similar story. It bottomed in about mid 2023, early 2023. And then the last couple of quarters, it's been getting better. It looks like Q3 of last year wasn't the best, but still the trend was definitely in the right direction. The cash to debt ratio is not great. I'm going to be honest here. Nearly $6 billion of debt with 800 million in cash. Not the best ratio there. Shares outstanding. Well, it's definitely not good. I've seen worse than this though, but it's the direction it's going in is generally not good. So that one's not going to get a check on my list. Return on capital. 5% for the quarter. That's okay. That's not great, but not horrible. So I mean, personally, I'm not interested in buying the stock at the moment. If we look at the valuation history, we can see that, the time to buy it was 2023 because with where the valuation is now, we're pretty much getting right back to where we were, 4 years ago now. And so it's just been getting more and more expensive the last 2.5 years. So really, this is not a stock that I'd be interested in buying at the moment. But they have a couple of good things going for them. I mean, the EPS is headed in the right direction. I mean, $1.47 expected for 2024, then 277, that's nearly a double up. So I can see why the stock is going up. I mean, revenue growth is solid, 24% and then 17%. So they have some good numbers and they got some bad numbers. But personally, for me, this is not a stock I will be buying. But thank you for watching, and I will see you in the next video.